In this video, we'll review sale leasebacks. It sounds complicated, but it's really not. Just treat it like two separate transactions. First, record the sale, and second, record the lease. First, the seller sells an asset to the buyer and then leases it back from the buyer. Note, generally, the leased asset never moves. The sale and leaseback happen at the same time. Initially, the seller lessee sells the asset, but then the seller lessee gets it back in the lease. It doesn't need to move. The asset just gets sold and leased back on paper. It's a way for the seller lessee to get a lump sum of money today and then pay it off slowly in the future, just like a loan. With one thing to note, if the leaseback is a finance lease, then the sale leaseback fails. Why is that? Well, remember, a finance lease is just another way of saying purchase. You can't sell and repurchase something at the same time. That doesn't make sense. That's a wash. Then in substance, there is no sale and lease. Remember, a lot of accounting is substance over form. For a failed sale leaseback, it's really just a loan. Then we record it like a loan. Let's see how this plays out with some examples. Just by eyeballing the prompt, you can tell there are a lot of words. Let's organize the details as we read through the prompt. On January 1Y1, Maverick sells an airplane to Goose for cash of $100,000. Immediately before the transaction, the airplane has a carrying amount of $80,000, with an original cost of $120,000 and a remaining useful life of 8 years. At the same time, Maverick enters into a contract with Goose for the right to use the asset for 4 years with annual payments of $10,000, payable at the end of each year. The implicit rate in the lease is 5%. Provide the journal entries of Maverick on January 1Y1. Whew, that was a lot! But don't worry, just break it down one sentence at a time. The prompt tells us that, first, Maverick sells an airplane to Goose. There's a sale. Then, at the same time, Maverick gets the right to use the asset. What's a right to use an asset? That's just another way of saying lease, because a lease is just a right to use an asset. So it looks like Maverick leases the asset back from Goose. Then this may be a sale leaseback. To figure that out, let's see what kind of lease this is. Checking the question again, it asks for Maverick's journal entries. Who's Maverick in this problem? The prompt says Maverick sells an airplane to Goose. That makes Maverick the seller. Then it also says Maverick enters a contract for the right to use the asset. Maverick doesn't own the asset. He's just paying for the right to use the asset. Then Maverick is also the lessee. And remember, the lessee is full of F, finance, O, operating, and S, short-term. Starting with F, finance. If we hit any one of the 5 criteria, then it's a finance lease. The prompt doesn't say anything about ownership transfer, a purchase option, or no alternative use. So criteria 1, 2, and 5 are out. That leaves criteria 3 and 4. Under criteria 3, we know the lease term is 4 years, divided by the useful life 8 years, which equals 50%. That's less than 75%. We did not hit criteria 3. And for criteria 4, we need the present value of the lease payments. What goes into the lease payments? Just remember, lease payments are a very ripe fig. V, variable payments. R, reasonably certain payments. F, fixed payments. I, less incentives. And G, any guaranteed residual value by the lessee. The prompt doesn't say anything about variable payments, reasonably certain payments, incentives, or any guaranteed residual value. Let's cross those off. We do have annual payments of $10,000. Maverick has to pay rent to use the plane. The annual payments are fixed. The prompt tells us that this lease is for 4 years. Then these lease payments are non-current and get recorded at present value. Then we use the present value factors given. For the $10,000 annual payment, we know Maverick makes the same payment each year. What do we call that? An annuity. Here, the annuity payments are made at the end of each lease year. Then, it's an annuity in arrears, also called an ordinary annuity. So we use 3.546. Let's calculate. 10,000 times 3.546 equals $35,460, present value of the lease payments. For the 90% test, we divide by the fair value. Here, we use the current sales price as fair value, $100,000, which equals 35%. That's less than 90%. We did not hit criteria 4. We missed all 5 criteria. This is not a finance lease. And this lease also has a term of more than 12 months. It is also not a short-term lease. Then this is an operating lease, which means it qualifies as a sale-leaseback transaction. Let's do Maverick's journal entries at 11Y1, commencement. This is a sale-leaseback transaction, so account for it as 2 transactions. First do the sale, then do the lease. Starting with the sale, Maverick sells the airplane to Goose for cash of $100,000. Maverick's the seller, he's getting the cash. That's cash increasing, debit. What's the other side of the entry? Maverick's selling the airplane. He's got to take the airplane off his books. The prompt tells us that the airplane's carry value is $80,000, but it's on Maverick's books for cost, $120,000. The airplane's an asset going down, credit. And we offset that with accumulated depreciation, calculated as the difference between the original cost, $120,000, and the current carry value, $80,000, which equals $40,000. Accumulated depreciation is a contra asset. It runs contra to the plane. Debit. Are we done? We have a difference, and it's on the credit side. And the difference is for $20,000. Where does this go? To gain or loss. Here it's on the credit side. That's a gain. Now for the leaseback. This is an operating lease, and Maverick is the lessee. At commencement, an operating lease looks just like a finance lease. The lessee records lease liability, which is the present value of the remaining lease payments. At commencement, no lease payments have been made, so we use the full $35,460 as the lease liability. What's the other side of the entry? The right of use asset, because that's what the lessee is getting, a right to use the leased asset. That's an asset increasing, debit. And remember, a right of use asset is a lip, it's a lip, it's a lip, lip, lip. A right of use asset is a lip. L, lease liability. I, initial direct costs. P, prepayments. The prompt doesn't say anything about initial direct costs or prepayments. Let's cross those off. Then the right of use asset is just the lease liability, $35,460. Do our debits equal our credits? Yes, they do. This is the same prompt. The only difference is, rather than annual payments of $10,000, it's been changed to annual payments of $26,000. We already know that Maverick is the seller and the lessee, and the lessee is full of shit. Starting with F, finance. Once again, the prompt doesn't say anything about ownership transfer, a purchase option, or no alternative use. So criteria 1, 2, and 5 are out. And for criteria 3, we calculated 50%, which is less than 75%. We did not hit criteria 3. And for criteria 4, we need the present value of the lease payments. What goes into the lease payments? Just remember, lease payments are a very ripe fig. V, variable payments. R, reasonably certain payments. F, fixed payments. I, less incentives. And G, any guaranteed residual value by the lessee. The prompt doesn't say anything about variable payments, reasonably certain payments, incentives, or any guaranteed residual value. Let's cross those off. We do have annual payments of $26,000. Maverick has to pay rent to use the plane. The annual payments are fixed. The prompt tells us that this lease is for 4 years. Then these lease payments are non-current and get present valued. Then we use the present value factors given. For the $26,000 annual payment, Maverick makes the same payment at the end of each lease year. That's an annuity in arrears, also called an ordinary annuity. So we use 3.546. Let's calculate. 26,000 times 3.546 equals $92,195, present value of the lease payments. For the 90% test, we divide by fair value, $100,000, which equals 92%. That's more than 90%. We hit criteria 4. This is a finance lease, which means this does not qualify as a sale-leaseback transaction. The rule is, if it's a finance lease, it's a failed sale-leaseback. Well, if it's not a sale-leaseback, then what is it? It's just a loan. Let's do Maverick's journal entries at 11Y1, commencement. Goose is still giving Maverick $100,000 cash. That's cash increasing debit. What's the other side of the entry? It's a failed sale-leaseback. Then it's just a loan. Note payable. That's a liability increasing credit, $100,000. Do our debits equal our credits? Yes, they do. Just to summarize, for sale-leaseback transactions, just treat it like two separate transactions. First, record the sale, and second, record the lease. And note, if the leaseback is a finance lease, then the sale-leaseback fails. Because a finance lease means it's really a purchase. That would make the transaction a sale and a repurchase. That's a wash. So when the sale-leaseback fails, it's just a loan. Next up, we'll tie up some loose ends for leases and then onto some practice problems. You want to be sure to hit these points on the exam, so stay with me. I'm Liz Cho with Test Prep in a Snap.